Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Roster with Victory Fiduciary, and today we're going to get into a couple of things that we've seen happening in the market. Obviously today is Inauguration Day for President Biden and Vice President Harris, and so markets have really had a pretty strong advance, certainly for the past week and a half, 2 weeks. Yesterday and today, so far as movements have been particularly strong. On Friday, we saw markets pull back a little bit from their highs, but really all week we've seen some really strong kind of forward motion leading us into this Inauguration Day. And so, the question really remains, what's driving this, these new rallies that we're seeing, and then do we think that they're going to be sustainable for the short and the intermediate term? And so the question is that we hope so, but there seems still to be a lot of kind of exogenous things that are kind of helping to prop up the market. So we'll see. Certainly stimulus remains on the markets, kind of the front page for them, wondering if we're going to be able to see these new stimulus packages that President Biden has been proposing, if they'll actually make it through the House and the Senate to be passed, talking about more direct payments to households, which would just kind of automatically provide a temporary lift to markets, certainly. So for that, we'll have to see. I think that right now markets are certainly riding on that hope that we're going to be able to see some additional help come down the pipeline soon. So right here, what we're looking at, S&P 500. So as you can see, we've been still kind of making a pretty decent advance here. Very deviated, though, from our long-term moving averages, our 50 and our 200-day moving averages. We are extremely deviated here. And so, one of the risks in the market right now is that when we look at exuberance and when we look at where investors are, and honestly, everybody's all in at this point, that can absolutely trip up the market if something kind of comes down the road unexpectedly. Right now, everything is strong, is positive. We see lots of great momentum and relative strength really across the board in most areas of the market. But when we get to these areas of deviation, that is certainly still a word of we should be having caution, certainly making sure that we're in the right areas, at least those areas of strength, because there's always areas of the market on the fringe there that have inherent extra weakness that we don't need to be taking part in. So that's where we are right now with the S&P 500. We'll see where we close today, but certainly we've had a very strong advance for the last 2 days. And so really quick, wanted to also kind of show you though. So Dorsey Wright, this is one of the programs that we use for our math and rules based when we look at how we're going to actually invest. When we make up our investment allocations within our models, this is one of the main programs that we use to kind of help us. So you can see within DALI, not a ton of change. Small and mid cap growth are in the number 1 and 2 position. Large cap growth has dropped a little bit. So large cap growth for a long time since the pandemic and we began this recovery, large cap growth was number 1 far and away. And we've seen that begin to cool off some. And so it could be that just as some of these other laggards have kind of leapfrogged over them, they've kind of gained a little momentum over them. So we've been kind of keeping an eye on this. Still, though, a very strong area. And I'm going to show you. So within large cap growth, I want to kind of show you. It's going to let me. There we go. So how it works. Oh, I should have stayed on this side. So we see that we clearly we've lost a little bit of positioning from the first and second position. But this was one of the funds that we have in our models. So this is going to be the NASDAQ Equal Weight Fund. And so we can see that even though it's lumped into this area of large cap growth, which is kind of lost some strength in buy signals, still at a score of 5.6, which I don't know if you can see that here, but 5.6 with the arrow going up, it's a very, very strong score. The highest that we can have is a 6. So this being a 5.6, the fact that we're on a buy signal and a column of X's, which simply means that our momentum is continuing to kind of shift upwards, and that, let me just show you here. And so here, really, price advancement has just kind of continued to kind of be on a exponentially higher. And so those are things that we look at. So certainly, even though the entire arena of large cap growth is kind of showing some signs of kind of slowing down and some weakness, you can still pick out the areas of those that are still kind of like the diamonds that are still there. And so that, like I said, this is one of our large cap funds. We have this in the Vanguard S&P 500 fund right now. So I just thought that that was interesting to kind of be able to show you. With sectors here, so consumer cyclical and technology. Again, this was a little bit of a leapfrog because tech has kind of been king since we kind of began into our recovery and even throughout the pandemic. And consumer cyclical just leapfrogged over them with their relative strength and buy signals. Technology is now at 196 versus consumer cyclicals at 200. Both still very strong. What's been interesting though is energy has literally just been on a tirade. It was one of the very last laggards and it's really moved up quickly in DALI here under our sectors. So it's an area that we're watching, not quite ready to pull the trigger on, but it has certainly shown improving relative strength. What we need to see now though is if this relative strength is going to hold, and if it's, instead of just kind of like being a sector rotation or a fad fund, we want to make sure that it's showing positive strength over the long run. And so we'll be looking at that. International continues to hold the strength that we saw, and so we did add international back in December to our portfolios as a result of increasing within DALI and relative strength. So not a whole lot changed there. So really big picture here, not much has changed since we last talked about it. Domestic equities remains far and away the best place to be in terms of equity exposure, small cap growth, mid cap growth, and then large cap growth right there. And fourth, small cap blend is an area that has been showing a little bit of increased strength as well. And then again, consumer cyclicals, technology, basic materials, then followed by energy. So we look at this on a daily basis. We don't make changes, obviously daily, but we want to look at the trends and kind of make determinations on what areas are heating up, what areas are cooling down. Because remember, if we can avoid the laggards here and kind of overweight ourselves here, that's how we can outperform the market over the meaningful period. If we were just kind of putting our money across the board regardless, I mean, if we were putting in areas that were having decreasing momentum and relative strength, those areas would likely wind up pulling down our performance for our portfolios. So that's how that kind of works. So not a whole lot of change in DALI, but again, we're watching that. So the last thing that I just want to do, because we haven't done this in a while, is I wanted to show you with the models just kind of want to show you where these funds have kind of been since the last time we talked. So we look at the tactical holdings, because remember, we have one main goal, and that's to find ways to outperform the S&P 500 over the long term. So in order for us to do that, that means that we can't just invest in the S&P 500 index fund. When we do that, then we're kind of limiting, saying that's really as good as it's going to be able to get. So we kind of use the S&P 500 as like our bogey marker, and then we try to find areas of higher relative strength when they're there, and we want to put our holdings there when we can. So so right now, and let's do this over the past 3 months. So over the past 3 months, the Vanguard S&P 500 total return has been 11.25%. So then let's go and let's take a look at what some of these other funds then have done. So 11.31, that's going to be our S&P 500 fund. So obviously very close to the actual S&P 500 total return. And then followed by that at 13.7%, that is our building and construction fund. At 16.19%, that is our NASDAQ equal weight. That's kind of like our other large cap growth fund that I just showed you about. 17.69, that is our mid cap fund. 20.33% is our consumer discretionary fund. 21.9% return is our small cap fund. 22.58 is our innovative technology fund. 23.45 is the our international fund, which remember that's the fund that we just added back in December when we saw that rising relative strength. And then 29.43 is our online retail fund. And so as you can see, everything really but our S&P 500 fund, which only invests in the index, vastly outperformed the S&P 500. So that's the idea. This is how this works. That's how that once we have kind of the all clear to be in equities, it really guides our hands, helping us to be in those greatest areas while trying to avoid those weak areas at the same time. So again, that's really all that I wanted to talk about today. Certainly market movements have been quite strong over the past couple of days. Hopefully we'll continue to see that. I would say though that we shouldn't, number one, get used to seeing these significant returns where we're seeing returns of over 1% daily. That's really not sustainable over the long run. We'll take it obviously when we can, but understand that it's likely that the market will probably need to cool off at some time the next couple weeks. Again, we're very overextended, so these are things that we look at, and so even a pullback from where we are or would not be completely out of the realm of possibilities right now, since we've had such a strong advance. And so I would say that just kind of keep that in the back of your mind, that markets, believe it or not, they cannot just go straight up. We have to have periods of kind of a pullback so that markets can kind of pause and catch their breath before they move on again. We saw that, remember, back in September and October, where we saw 10% corrections back in September, particularly, where we saw a pretty significant pullback, and then we saw that again in October. So we really haven't seen a whole lot of corrective action since those times. So again, just keep that in the back of your mind. If you're kind of trying to determine to deploy more money or different things, make sure you kind of have a clear picture of where we are in the market. Also having just a clear picture in general of where are you specifically deploying money, because that is a big part of having overall long-term success, is making sure that we have the right allocations. If you have any questions, you can always give me a call or email me, ashleyr@victoryfiduciary.com. I always welcome your feedback. I hope you enjoyed today's video, and we will get back with you next week. Take care.